This show is part of One Place, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. I'm here with the latest on tech, finance, and global markets. We have a packed schedule today covering everything from AI economics to major shifts in retail.
NVIDIA's CEO says AI tokens are the new corporate currency.
Sam Altman envisions tokens as a form of global income.
Lobster hats and claw poses become AI's viral symbols.
A gaming CEO used ChatGPT to dodge a massive bonus.
Oil prices drop as Iraq secures a new export deal.
Colleges launch private loans to bypass federal borrowing caps.
Hidden housing costs are pushing homeowners to the brink.
Vibe coding becomes the must-have skill for non-technical hires.
Disney's new CEO faces pressure to find next-gen growth.
Chinese giant JD.com launches Joybuy to challenge Amazon UK.
First, NVIDIA's token talk.
NVIDIA CEO Jensen Huang is making waves at the GTC conference by focusing on a concept most of us are just starting to grasp: tokens. He's framing future computers not just as tools, but as manufacturing equipment designed specifically to produce these tokens. For those unfamiliar, tokens are the basic units of text that AI models use to process information. Think of them as the currency of artificial intelligence. Huang suggests that tokens will soon become a standard line item in corporate budgets, right next to software subscriptions or hardware costs. He even floated the idea of giving engineers token budgets worth half their annual salary to attract top-tier talent in Silicon Valley.
It's a fascinating shift in how we value work. Huang argues that providing engineers with massive token budgets makes them significantly more productive, especially when using AI agents to handle complex tasks. Unlike traditional software that has a flat subscription fee, AI is priced by usage, meaning the more you interact with it, the more tokens you consume. Huang mentioned he'd be happy to pay an extra $1,000 a day in token costs during crunch time if it meant his highly paid engineers were performing at their peak. This concept is already trickling down into the hiring process, with job candidates asking about compute access during interviews as if it were a standard benefit like health insurance.
Now let's shift to...
While Jensen Huang sees tokens as a productivity tool for engineers, OpenAI CEO Sam Altman has an even more expansive vision. He's suggesting that AI tokens could eventually serve as a foundation for universal basic income. Altman's idea, which he calls universal basic compute, would give every person a slice of a model like GPT-7's processing power. People could then choose to use that compute for their own projects, donate it to scientific research like cancer studies, or sell it to others for a profit. It's a radical departure from traditional cash-based welfare, essentially giving citizens ownership of a portion of the world's total productivity. Altman believes that raw intelligence will eventually be treated like a utility, similar to water or electricity.
This vision relies heavily on the massive build-out of data centers, which Huang calls token factories. However, Microsoft's Satya Nadella has added a note of caution to this grand plan. He warned that the tech industry might lose the social permission to use scarce resources like energy if these tokens don't deliver tangible improvements in areas like healthcare, education, and public sector efficiency. The stakes are high because the business model for almost every major AI provider is shifting towards selling these tokens. If they become the backbone of a new global economy, the pressure to ensure they provide real-world value will be immense. It's no longer just about chatbots. It's about the fundamental infrastructure of future wealth.
Next up,
the AI world isn't all serious budget talk. It's also developing a very strange and visible culture. OpenClaw, a popular AI agent, has sparked a viral trend involving lobsters. We're seeing tech leaders and engineers wearing plush lobster hats and posing with their hands in claw shapes. Peter Steinberger, the creator of OpenClaw, even showed up to NVIDIA's GTC event wearing a lobster headband. This isn't just a silly joke. Experts say it's a way for users to build a sense of identity and community around the technology. In China, the trend is just as big, with fans attending meetups in full lobster gear and sharing photos of lobster-themed meals on social media platforms like RedNote.
It's really the tech world's version of a secret handshake. We've seen Y Combinator CEO Gary Tan appearing in a full lobster suit on his podcast, which just goes to show how far this has permeated the industry's upper echelons. Engineers are posting photos on LinkedIn with their claws up, signaling their involvement in the OpenClaw ecosystem. This kind of virality is a powerful driver for adoption, making a complex AI tool feel approachable and fun. Whether it's lobster hot pot in Shenzhen or lobster headbands in New York, the Claw has become a symbol of belonging in the fast-moving AI agent space. It proves that even in a world of high-stakes algorithms, human connection and quirky branding still matter.
Now let's shift to...
A bizarre legal battle has emerged in the gaming industry involving the publisher of Subnautica 2. A U.S. court recently ordered South Korean publisher Krafton to reinstate the leadership of Unknown Worlds Entertainment after a failed attempt to fire them. The conflict began when internal projections showed that the studio was about to hit targets that would trigger a $250 million bonus, or earnout. Krafton's CEO, Chang-Han Kim, reportedly felt the deal was a mistake and looked for ways to avoid paying. Surprisingly, Kim turned to ChatGPT for advice on how to handle the situation. The AI initially said the earnout would be hard to cancel, but eventually suggested forming a task force to either renegotiate or take over the studio.
The court found that Krafton followed many of ChatGPT's recommendations, including a strategy to secure publishing rights and prepare a legal defense. When they couldn't get the studio heads to renegotiate, Krafton fired them, alleging they weren't spending enough time at the studio. However, the judge rejected these claims, calling the move an attempt to dodge a legitimate financial obligation. The ruling not only returns operational control to the original CEO, Ted Gill, but also extends the time frame for the studio to meet its bonus criteria. It's a cautionary tale about using AI for sensitive corporate maneuvers. While ChatGPT can provide tactical suggestions, it doesn't account for the legal and reputational risks that a human judge will ultimately evaluate in a courtroom.
Next up,
global markets are seeing a bit of a relief rally today as oil prices fall. The primary driver is a new deal between Iraq and Turkey to resume oil exports through the port of Ceyhan. This is a significant development because it provides an alternative route to the Strait of Hormuz, which has become increasingly dangerous due to regional conflicts. Investors are hopeful that this will prevent a prolonged oil shock as crude supplies can now bypass the most volatile areas. European markets, including Germany's DAX and France's CAC 40, are trading higher on the news. In the UK, the FTSE 100 is also making gains, recovering some of the losses sparked by recent tensions in the Middle East.
The drop in oil prices is also having a positive effect on government bonds. In the UK, gilt prices are rising, which pushes down borrowing costs and eases some of the inflation worries that have been weighing on the economy. 2-year bond yields have hit their lowest point in a week. However, it's not all good news everywhere. Switzerland has actually lowered its growth forecast for 2026, citing the ongoing uncertainty and high energy prices caused by the conflict. While the Iraq-Turkey deal is a step toward stability, the broader economic impact of regional instability continues to linger. For now, though, the market is breathing a sigh of relief as more supply becomes available through safer channels.
Now let's shift to...
Higher education financing is undergoing a major transformation following President Trump's recent student loan overhaul. The new legislation introduces strict lifetime borrowing caps for advanced degrees, including a $100,000 limit for graduate programs and $200,000 for professional tracks like medicine. In response, several prestigious universities are launching their own private lending programs to fill the gap. Washington University School of Law, for instance, is now offering in-house loans of up to $25,000 a year at a fixed 7.5% interest rate. This move allows the school to manage the entire process, from counseling to repayment, ensuring that students who have exhausted federal options can still afford to complete their degrees.
While these university-funded loans provide a lifeline, they also come with risks. Private loans generally lack the federal protections and oversight that borrowers have come to rely on. Critics argue that excluding certain high-cost programs, like advanced nursing, from the professional designation could force students into even riskier lending markets. Other institutions like Yale School of Public Health are also stepping in with competitive loan terms to replace the eliminated Grad Plus program. This shift toward institutional lending means colleges are becoming more like banks, taking on the financial risk of their students' future success. It's a bold experiment that could either stabilize enrollment or lead to a new kind of debt crisis if not managed carefully by the schools.
Next up,
homeowners are being hit by a wave of hidden costs that go far beyond their monthly mortgage payments. While many buyers focus on the sticker price and interest rates, expenses like property taxes, insurance, and HOA fees are skyrocketing. According to Navy Federal Credit Union, the average amount withheld for taxes and insurance has jumped 50% since 2020, rising from $400 to $600 a month. This surge is driven by a combination of rising home values and environmental factors, like wildfires and hurricanes, which have made insurance premiums much more expensive. Even those who secured low mortgage rates a few years ago are finding their budgets stretched thin by these unavoidable and rapidly increasing ownership costs.
The impact is being felt across all credit tiers. A recent analysis found that even homeowners with top-tier credit scores are increasingly falling behind on payments due to these steep insurance hikes. It's a dramatic shift that many people didn't plan for when they first purchased their homes. Some are even taking out personal loans just to cover the additional hit to their monthly expenses. While a slight dip in mortgage rates has made refinancing more attractive for some, it doesn't solve the underlying problem of rising maintenance and tax burdens. For many Americans, the dream of homeownership is becoming significantly more expensive to maintain than it was just a few years ago, regardless of their initial loan terms.
Now let's shift to...
If you're looking for a job in the media world, you might need to learn about vibe coding. This is a term being popularized by Stephen Bartlett's company, Flight Story. Vibe coding refers to the ability to build software and applications using AI agents without needing to know traditional programming languages. Isaac Martin, the director of innovation at Flight Story, says he now prioritizes this skill over traditional development backgrounds. The idea is that people can use their industry experience and creative thinking to figure out where value can be created, and then use AI to actually build the solution. It's opening up technical roles to a much wider range of people who previously might have been excluded from the innovation team.
Bartlett is known for valuing attitude and critical thinking over specific technical skills, and this vibe coding trend fits perfectly into that philosophy. He even uses a 35-question culture test to screen candidates for things like curiosity and a bias for action. The belief is that in a fast-moving world, technical information is easily accessible, so hiring for cultural alignment is more important than hiring for existing knowledge. Vibe coding allows non-techies to become creators, starting their own companies or developing apps within their current roles. It's a shift that suggests the future of work might be less about what you know how to code and more about how well you can direct AI to do the coding for you.
Next up,
Josh D'Amaro is officially taking the reins as Disney's CEO, and he's stepping into a challenging environment. While he's well-liked by employees and park guests, Wall Street is looking for growth that has been stagnant for years. Analysts suggest that D'Amaro needs to move beyond just relying on existing franchises and sequels. The goal is to find new intellectual property that can live across all of Disney's platforms, from theme parks and merchandise to streaming and video games. There's a particular focus on winning over a younger generation that wants more interactive experiences. This means breaking down the traditional barriers between the audience and the content, allowing fans to feel like they are part of the story rather than just spectators.
one of the biggest opportunities for D'Amaro lies in video games. As the superhero bubble shows signs of wobbling, games could provide the next big hit for Disney. The company needs to figure out how to integrate AI and handle its declining traditional TV networks while keeping the creative flywheel spinning. Shows like The Bear are great for prestige, but they don't always translate into the kind of sellable merchandise and park attractions that Disney thrives on. D'Amaro's background in the experiences division gives him a unique perspective on how to build these multi-platform hits. The pressure is on to prove that Disney can still innovate and capture the imagination of a new generation in an increasingly crowded media landscape.
Now let's shift to
The UK retail market is getting a major new player as Chinese e-commerce giant JD.com launches its Joybuy platform. This £30 billion company is aiming directly at bargain-hunting British shoppers, positioning itself as a serious rival to Amazon. After walking away from potential deals to buy established brands like Currys and Argos, JD.com has decided to build its own presence from the ground up. They are offering a wide range of products, including technology, home appliances, and groceries. To compete with Amazon's dominance, Joybuy is launching with next-day delivery for 17 million households, supported by its own logistics operations and distribution sites in Milton Keynes and Luton. It's a bold move into a highly competitive market.
JD.com's leadership says they are in the UK for the long haul. They've spent significant time testing their web and app propositions to ensure a smooth customer experience. This UK launch is part of a broader European expansion, with simultaneous rollouts in Germany, France, and several other countries. Last year, they even acquired a major electronics retail group in Germany to bolster their presence. By focusing on a combination of product variety, value, and convenience, Joybuy hopes to entice customers who are looking for alternatives to traditional retail giants. It will be interesting to see if their logistics-heavy approach can truly challenge Amazon's established network and win over the loyalty of British consumers who are increasingly price-conscious.
That's our roundup for today. Thanks for joining us for this briefing. We'll be back tomorrow with more stories. Follow us to stay updated on the latest news and trends.